as Matt alluded to earlier, some of the businesses that we work with are kind of firmly in the lower middle market. So anything even down to $10 million in revenue up to several $100 million. And we also work with some smaller private equity firms. So we've been looking in the lower middle market, kind of both sides of the aisle. I think at onset, and this is probably not dissimilar from what the people on the call have seen, there's a significant drop in M&A activity, especially from March to May, and looking in the rearview mirror at June, there's somewhere close to 50% drop in M&A activity in the middle market. And I can say that at onset, probably about a third of our deals went on hold. But something that we'll probably talk about more today is deals that had a real strategic niche that was filled by being done and transacted or completed. Those deals have continued. There has been a bit of lumpiness depending on what sector the deal is in or where the asset is located. And further, if you're a publicly held strategic versus a smaller privately held business, you probably have better balance sheet, more liquidity, more cash to deploy. So there's definitely been some sector specific drivers, thinking technology, business services, where there's been less of a pandemic effect. And it's the same thing with private equity. Some of them have more pandemic resistant portfolios and portfolio companies versus others. But generally speaking, at least as of July 30th, we've definitely seen a bit of a rebound. And that's everything from the leverage markets to the financial sponsors to the private or large strategics. And I would say that at least with the bulk of our business coming from business owners, it's very much a case-by-case basis, depending on how their business is doing and how they may have personally been affected in terms of their family.
I would just add, in general, for the last, we're coming up on 5 months now, I look at this pandemic almost like the stages of grief after we lose somebody. Those first 7 or 8 weeks was shock and awe. Everybody was just paralyzed, for lack of putting it better. And then like week 8, week 9, all of a sudden, I started seeing more outreach, just conversational, from attorneys, financial advisors, owners we've talked to in the past, just to kind of dip their toe in the water. And over the last, say 8 weeks since then, now that we're coming up on 5 months, I can't believe it. There's been continued dialogue and activity, but it's, from what we see, it's become the haves and the have-nots. And the haves are in certain industries, which Melvyn alluded to, where business is strong and good, and whether on the buy side or the sell side, if they're on the buy side, they're in good shape and looking for opportunities. If they're on the sell side and they were on the cusp of selling and they're in the right industry, like food distribution or beverage, I've talked to some beverage distributors that have actually said, we have to turn our phones off. We cannot keep up with the demand. Now, they're not in sell mode, but ones that are in sell mode are looking to take advantage of that. And we, from a personal standpoint, our firm has seen an uptick in healthcare related businesses, like, physical therapy practices, ophthalmology, and depending on where you are in that realm, what's the recovery going to look like? Can you weather it on your own, or has this sped up the necessity for you to sell to somebody larger with deeper pockets and more strength? So it's really, and then there's the psychology of the whole thing, which has been fascinating to me, for the owners, even the ones that are engaged in a process now, what they're struggling with as we try to go through the process. But I think that's the best way to sum it up. We're out of the shock and awe. We're into the, okay, what do we make of this situation? And now it's like, okay, what can we do, or what do we need to put off? So it's been fascinating, to say the least.
Yeah, those are all great points, and just curious about the business owner psychology. Just curious, Michael and Jeff and Melvyn, what have you seen change the most about that in the last couple of months?
So I'll share with you guys. It's actually, the owner is it's an owner late 60s, and knows they need to sell, and they're in specialty medicine, and they want to sell because they know they're going to have to be a part of a transition over 2 or 3 years. But despite the fact they had a record quarter, January to March, she's shell shocked is the best way to describe it. And, you know, it's not a very large practice. I mean, the EBITDA is probably $1.5 million or so. So it's very profitable, but she's still of the mindset, we're going to get lowballed. And no, let's not put that, let's not tell them this, and let's not tell them that. And just trying to get her comfortable with everyone's dealing with these same challenges. And the buyers, especially in that industry, they're implementing a roll-up strategy. So they're attacking the same challenges that you are, but they're doing it on a bigger scale. So don't price the deal for them. Don't, you know, you might have to accept terms that maybe you didn't think you'd have to, but just try to calm down, focus on recovering the practice, and she's getting there. But walking her through the mental part of just trying to stay focused on both things, it's always challenging, and everybody on this call works with business owners in some capacity, but the psychology of it has been, I mean, it's taken it to a new level.
Yeah, I have to say that we're experiencing the same thing here. It seems like there's really two types of sellers right now, especially when we think about the market that we operate in the middle market. And on the one hand, we have sellers that, to Michael's point, might be in their 60s or their 70s, the typical kind of entrepreneurial-led, multi-generational, family-owned business. And some of those founder-led organizations, they might be just tired, for lack of a better term. You get beaten up, maybe the balance sheet's in trouble, maybe you need cash. We've been seeing more recapitalizations, not necessarily by choice, but by necessity. Even though there's been funds flowing freely from the Fed with PPP loans, which we've all talked about ad nausea, there's a lot of activity there to help bridge liquidity. And I think some of the sellers that we're working with and business owners are thinking about how it's affecting their future. They're thinking about it from the perspective of exit planning in particular. You know, we had such great valuations in the marketplace for a while for closely held businesses, and now that's been shaken up a little bit, especially with what's going on in the leverage markets. But we have a client in the pediatric home healthcare space that's based in Southeast, probably about $3 million so in EBITDA. And to Michael's point, they wanted to sell to find a partner because they're running into issues with one of their managed long-term care providers that wants to renegotiate rates. They were initially really concerned about getting an attractive valuation, but because they still had attractive value drivers in terms of the standard of care, in terms of their EBITDA, in terms of their growth profile, we were still able to get them to a valuation that was attractive, although there was some structure to it. And I think that's something else that owners have to contend to when they're thinking about deals. It's not like you're getting an all cash upfront purchase price as much as you did in the past. Now there's a lot more earnouts or just forms of contingent payments, whether that's a seller's note or something else. And I think as advisors, whether you sit on the M&A side of things or we sit on the wealth management or exit planning side of things, I think it's important to have conversations to give our clients comfort so that they're prepared when the time does come to sign a letter of intent and go through due diligence.
Yeah, further to what Melvyn and Michael were discussing, I'm having similar experiences. I'm working actually with a manufacturing client who is not quite in his 60s, but is looking to get out. And he seems to be of the view that certainly his sales are significantly down from where they were pre-COVID. I think he's open. He is willing to take even a lower purchase price for his business because he doesn't know what the future is going to bring. And the valuation that he thought that he would get a year ago is not looking like what's going to happen now. So I think the buyers in this environment, a buyer has a lot more leverage to negotiate, and sellers, unless they're willing to stay on and run and let this situation run its course, sellers are more open to considering offers that may be below what they would have been pre-COVID.
Yeah, and the flip side to that is, what if you have a client that's performing really well? And I think everyone here has clients that are on that side of the table. And because of the fact that certain groups, especially on the privately held business side or the financial sponsor side, can't necessarily get the same amount of leverage or debt to finance transactions, we've definitely seen, even for some better performing businesses, that whether it's food or healthcare or technology, have actually run into issues in terms of not getting valuations that they wanted. Now, maybe they absolutely need to sell because they need a strategic partner to continue investing and growing the business. But maybe they should wait. And I think timing is something, if you're not in the buyer group where you're running into issues and you need to bridge liquidity, for that second bucket, maybe holding off is a better thing to do right now. But there's still so much uncertainty. It's hard to tell.
I actually questioned for Jeff, because you made an interesting point. The client who's now considering maybe an offer that he wouldn't have considered 6 months ago or a year ago. I would ask you and anyone else that's on the call, we all have different types of clients. Is that individual, Jeff, somebody that's now said to you, you know what, maybe staying around here for 2 or 3 years is now something I'll do, and I'll accept a little bit less upfront and more of an earnout and an employment agreement? Are they having that aha moment? Because to your point, at least now they're part of somebody, and this is what I've had the same conversation with owners. You can try to navigate this next 12 to 36 months on your own, your call, but just know what you're getting yourself into. Or is that individual someone who's saying, you know what, Jeff, let's explore that. Maybe I'll take a little less, more on the back end, and an employment agreement. Are you?
Yeah, actually, that's exactly where the conversation is going with this client. He does want to stay on. He's willing to invest the next 2 or 3 years and try to get more money at the back end and take a little less at the front, at the purchase price, and see where it goes. But that's really the conversation where it's going. Like I said, he's not at that point where he's ready just to retire. And I think he wants to continue, and if he can get good earnout terms and a good employment agreement, he'll be up for going forward with the right deal. So that's sort of the conversation we're having now.
Yeah. Go ahead, Michael.
No, I was just going to ask if anyone else on the call has like an interesting real-time example of, hey, I have this one client where all of a sudden he's welcoming that. If not, no, but I happen to love that model because that is the backbone of a win-win. So if anyone else, I'm curious to hear.
I think everybody's line is muted, but if you have an answer and would like to respond, you can unmute yourself currently.
Michael, we have a client who's 74 and is now just engaged us to help prep for like a sale, and she's doing really well right now. But personally, I think do they have enough money already? Like, are they bound to the business? If they're not bound to the business, they can take less money today and be out, which is what this client wants to do. Take a little less and be out, because the extra $1 million or $1.5 million isn't the be all end all to have the earnout over the next 3 years. It's just not worth it to them. It really depends on, are they reliant on that money from the business to meet their needs? That's that's my personal opinion.
Yep, nice.
Yeah,
I have to I'm agreeing with Jeff. It's so critical to collaborate with somebody that can do the financial planning to determine what they need from the business, because that gives the client a much better perspective of how they manage this process. Because if they're just looking for the biggest number, now may not be the time. But going back to what Jeff said, and I see this so many times, that they get so focused on the transaction, they're missing the big picture and what do they want to accomplish and what do they need from a financial planning perspective, and what's the best way to structure it tax-wise. So very often I find that not the people on this Zoom call, but some people are just so focused on the transaction, they're missing the big picture. Because if somebody's tired, as Jeff said, it may not matter because financially they don't need it. But if they do need it, then We got to work with people that can grow the business and make the business better so it's more ready for sale. So that's a lot of the things that some of the people on this call help with from a collaboration perspective. So just wanted to add some comments from that perspective.
Yeah, I would just add to what Gary's saying. I think it's important to talk with your client and have a clear understanding of their objectives, whether they do what they're looking to do at the end of the day, what they want to get out of the sale process. So you can tailor and you can structure the right deal for them. And certainly working with the client's other advisors is really important to develop and understand what the client's real objective is and what they're looking to do. So I think that's definitely important.
Another thing is the business owner, sometimes nobody's done the analysis for them of what they need, because from a perspective is they've focused so many things on, like, the business is covering their boat, their country club, their cars, etc. They've got to run everything what they need on an after-tax basis, because when the business was paying for it, they were getting it as a deduction. When they pay for it personally, they're not going to get a deduction. So it's so important to look at that to determine the right number. And I see a lot of times, unfortunately, it seems so apparent to us that's so important, but I see that step is missed a lot. So work with somebody that can do that financial planning is so critical.
Yeah, Gary, we're working with a client now who's based in South Jersey, and he owns it's a second generation family-owned manufacturing business, particularly within precision machining. And one of the things that we did working with the tax attorney was just figure out what's the after-tax yield, whether it's a stock deal, an asset deal, 338H10, depending on how the contracts would be transferred, because it is with groups like Boeing and Lockheed Martin, since they're in the military and defense sector. But what was most important to him was, do I have enough money to retire and support my wife who has an illness, and also make sure there's the right custodian for the business after I leave? And we had 3 LOIs, but the group that we decided to move forward with wasn't actually the highest offer, but it was one where there was no earnout. It was cash. He had his real estate taken care of, and he knew that the business was in good hands because they actually knew the industry. So providing options is another way to help clients get there. And that's, I think everyone on this call does that.
Oh, those are all great points, because you really need to kind of get to the core of that, and what do they need to be able to get to the next phase of their life, right? And the last 4 months may have changed a lot of people's outlook and what they want to do and how quickly they want to end. So, I mean, I know from our perspective, being the financial planners and with the whole exit planning process, to everybody's point, what you're trying to identify is that wealth gap, right? What do you need to be able to live off of and survive? What can you sell the business for? And if you could do that now, then it might be the ideal time to do it. So all great points. And I think also to Gary and Jeff's point, doing collaboration in a silo is death, right? So that's why we all need to work together in the different concentrations, because there's not one type of discovery that any one person can do. Right. So working with everybody, I think, is the best way to do that. So if we could just kind of pivot a little bit, I know the due diligence that's done at the firms that you guys work at may be a little bit different. So I think for everybody on the call, maybe it might be helpful. Can you just all briefly go through kind of what the due diligence aspect looks like for your firm when you're working through a deal?
Yeah, I can answer that one first. So typically when we start a deal, we start first with the financials. A lot of times we'll engage an accounting firm, usually a small or mid-sized firm, depending on the deal, to do a quality of earnings, just to make sure that everything is in place. But even before that, we'll go through QuickBooks or Xero or whatever they have. That's probably the bedrock, because having supportable financials is ultimately what can first kill or spur diligence further with the deal that you're working on. We do cybersecurity depending on the type of deal. We'll do social media diligence, obviously legal diligence, tax diligence, but I'd say financials is first. And something that we try to do, since the middle market is so different from doing larger deals, is just think about really what the value drivers of the company are. Think about if the company has developed an exit strategy. Do they have a management team in place where an acquirer can get over the idea of key man risk? And a lot of times due diligence, I'm sure that Jeff and Michael feel the same way. It doesn't start when we get engaged, it starts long before that. So having advisors that can do some of the thinking in advance. So by the time we start writing a SIM or thinking about a buyer's list, obviously that's critical to our kind of work streams of going to market and marketing an asset. That really lends a lot of help to helping us get a premium valuation.
Yeah, I would just add to Melvin, that's sort of the structure and the organization we follow also. Looking at material contracts, looking what is the value, what is the revenue driver of the business, and for the client to have a real understanding of the customers and the suppliers and the contract commitments going forward, to get a real understanding of the value in the business. And with COVID, I think the logistics of due diligence has really changed. While with technology, you can do a complete due diligence review through a data room and upload documents. There's different timing has slowed a little bit. I always have said to clients, especially sellers, that it's really important at the outset to have your ducks in a row, to be organized, to be able to be responsive to buyer's diligence requests, because there's nothing that gets a buyer cold feet more than having sellers who don't have their things in order. And it raises credibility issues. It makes it more difficult to negotiate the deal favorably for a buyer. So I think for a seller. So I think it's very important to have the due diligence process and to get organized right at the outset. And that's sort of been the focus of what we've been doing.
So the one thing I would add as it relates to COVID is, we're the lower middle market. So our sweet spot is really that 5 to 25 million in sales company. So if you have a company that's 10 million in revenue and, EBITDA of $1 million and, 1 to 2 million, and it's usually local. I'm a big proponent of prospective parties meeting face to face sooner rather than later, not too soon, but I feel like that, especially at this part of the market, this level, that chemistry is essential. So I like to root out any potential problems earlier rather than later. So in this environment, how do you do that? And we've done, not that we rush to introduce everyone to the owner, but we've had a couple where, hey, we'll meet outside and we'll set up a couple of lawn chairs and, a buyer seller meeting outdoors. This was a month or two ago when things weren't. Now things have opened up a little bit more, so it's more lax. But we've done that. I was on a call the other day where it wasn't my firm, but there was a cross-border transaction that they were talking about due diligence. And they actually had the principals of each side on a Zoom call with their families. So like, here, this is my kids, and like, they have never met face to face, and yet they've gone through this cross-border diligence without ever meeting face to face. And they're on path to close the deal, which I found fascinating, but they're making it work. And when else would you see the kids of the two primary principals involved? When would they ever introduce them to their kids, in normal times? So I guess things are changing.
Yeah. And to Michael's point, these days you may have the principals never meeting in face to face. I'm working with a buyer who was looking to acquire a company located in Tennessee. They met pre-COVID. They haven't had a face-to-face meeting since then, and my guess is they're probably not going to have one before the deal closes if things continue the way it's going. So, getting everybody in a room and discussing documents and negotiating in person seems to be not the way things are going right now. But you figure out creative solutions to get the deal done and to have the principals comfortable with each other.
Yeah, and don't want to throw out too many overused terms, but the new normal is certainly something that we're all getting used to here, and leveraging technology and trying to make it as personal as possible. So, I think that that's a challenge with technology, but versus 10, 15 years ago, we're much more equipped to handle that now versus if it was 10, 15 years ago. So, and Jeff, you alluded to a few deal killers, in your last comment. Can the three of you just kind of touch on what are deal killers that you usually will come across? Have there been different ones in the last couple of months, and how do you kind of work through those?
Yeah, I can start. I think transparency in the process is really important. I'm working, one of the deals I'm working on now, we signed the stock purchase agreement a couple of weeks ago. Diligence started and the parties were communicating as early as last year. And 2 months ago, the seller disclosed, not voluntarily, but in response to questions, that they got a PPP money, about $2.5 million. And it just, my client just was obviously very concerned and surprised to find this out so late in the game. And we spent the next 3 weeks trying to work out a solution to deal with that liability, to my client's satisfaction and to the seller's satisfaction, and we're still talking about it. So I think transparency and not waiting till the 11th hour to disclose significant material issues is really important. Fortunately, both parties want to do the deal, but I could foresee a situation where if a buyer just is lukewarm about doing something, and that would end the deal right then and there. So I think it's really important to be open and upfront and transparent from the very beginning.
I would say we had a deal blow up in December, and it could be a case study for all of us in EPI, why you need the company to be buttoned up before you go to the market. And this was the typical old school, second generation owned, they're in the fire and sprinkler business. When it comes to HR and their employees, there were no non-competes. There were no, non-solicits. There was no protection for the owners, because everything was, oh, he's been here 25 years. And they didn't want to spend the time making those corrections. You can't just throw these documents at the employees and say, and then on the other hand, market the business for sale. So we took a calculated risk, and I explained it to them, and they knew what they were getting into. And sure enough, what derailed the deal was the key man that really had a ton of responsibility in a relationship. I said he may hold the deal hostage. I told him that from the start, and demand all kinds of extras. He didn't do that. He did something even worse. He sabotaged the deal and poisoned everybody else that worked there. And basically the deal fell apart, and he completely screwed over his boss of an employer of 30 years because he was pissed. But I know everybody on this call, a lot of guys, we know each other. We talk about, you prepare the business for sale, the HR part, the employees, it just makes it more transferable. So that's what blew it up. And now more than ever, it's actually a good time for us to talk to owners if they're thinking about it. Okay, address those things. But luckily we wound up finding a buyer quickly and sold the business 2 months later. But it was a bad situation, bad Christmas.
Michael, how did you guys 2 months later pivot to a totally different buyer if this key man had sabotaged it? How did you work through that?
So that's a great question. We wound up selling half the business to the right kind of buyer. We found the right kind of buyer, and they knew the risk. It was full disclosure, everything, because at this point the key man had left and started his own venture and was poaching or trying to poach clients. But we were able to monetize half the business, and There's an earnout component, and it's actually progressing better than everyone thought. The other half of the business we were supposed to sell, but because they sold the part that was inspection related, maintenance, the recurring nature.
Sure.
The division they didn't sell was more like installs and projects. And we were going to sell that. We said, all right, we'll find a home for this. But over the last 4 months, their 10-month pipeline of projects to work on dwindled to zero, because every project in the pipeline just cancel. And luckily they own the real estate. They said, this sucks, but I'm 69 years old and I'm not waiting this out, because it could be 1 to 2 years. So I'm out of here.
Yeah. Now that makes sense. We've seen that with some of our clients in the audiovisual space, or anyone that has to go into actual commercial or office buildings. That integration or installation part of the business is dried up, and managed services, anything recurring, seems to be what's in vogue. I think, to Jeff and Mike's point here, transparency is really the best thing to get in front of deal killers. I'm sure all of you have worked with clients, especially ones that are growing really quickly, that end up getting a large or fairly large customer concentration. That can happen with suppliers too. We always put it forthright in the SIM, and usually we position it as a customer partnership model and how that's driven sales, and hopefully the margins with that customer drive home the fact that this is actually an asset, not a liability, and hopefully there's contracts to back that up too. But I think 2 individual anecdotes. One, we worked with a company in the hardware distribution space in New York last year, and I don't know if any of you are familiar with the Wayfair decision, but basically around the nexus of how taxes work, especially with companies that are selling in different jurisdictions. And the company had a small sliver of their business. 70% was wholesale distribution, 30% was e-commerce. And out of that 30%, maybe 3% was sold on Amazon. We ended up having tax exposure in 20 different states. And we only found this out while we were actually doing due diligence towards the end of the management meeting. So we came out with it right away. We engaged Cohn Resnick to do diligence on the tax side, not just the FDD or the financial due diligence side. And the sponsor worked with us. I mean, their counsel worked with us, their tax team worked with our tax team, and we were able to, carve it out in an escrow what the potential liability was, but we worked through it. Another one, more relevant to COVID, was we were working on a cross-border deal with a New Jersey-based pet orthopedics company that made artificial hips and other implants for dogs and other pets. And the deal made a lot of strategic sense, because there was a Swedish-based private equity firm that owned really the mirror image of this company in Sweden. And they kind of had a large market share in Europe. We had a large market share in the US. Right when, I'm sure you all remember, when COVID broke out in China, and then it moved to Italy, and then before the US markets really went into free fall in the middle of March, Europe had the same issue happen. So when we were actually trying to close, is really actually the day that the market started to plummet in Europe is when we were trying to close. And the LPs actually got spooked and tried to pull the deal basically on deal day. So what we did was, and this deal killer, there's really no way to mitigate this. I mean, this is a last minute surprise. We had an all hands call, and we brought them back to why the deal made strategic sense. You guys are essentially gonna have 35-40% market share and be the biggest gorilla in the room. Sometimes I think and I have the habit of doing this, we can all complicate the deals. But the simple reason is, if it makes strategic sense, usually you can find a way to get it done. So.
Thanks, guys. Yeah, that was very helpful. With about 10-15 minutes to go here, there was just a few other things I wanted to touch on. Can you guys just talk about what are some of the main differences between strategic and financial buyers?
Yeah. Mike, I see you laughing. You want to take that one, or you want me to take that one?
Well, it's funny, because I look at the financial buyer. What we used to think of as a financial buyer is not really is not as much of a financial buyer as they used to be, because these private equity groups, some of them own so many portfolio companies already, and they're thinking more like a strategic than they are a financial, because the ones that are thinking just financial, especially the last 5 or 6 years, you're out of the mix. Like, it's not going to work if you're trying to, justify that financial return on investment. on its own little island, it's not going to work. And I'll tell you, I mean, we work on the buy side and the sell side. So I really try to put the objective hat on both ways, both sides, no matter. And when we're representing a seller, what do we do when we put together a target list? I mean, besides the strategics that might have an interest, it's the PE companies that are already in that space or related space. You know, so, and the PE, listen, you have PE firms that say, okay, once it gets beyond 10X, I'm out. I mean, 10X is that's a pretty high cap so I'd say they're not as financial as they used to be. The strategics, it's funny because the last month we've had some interaction with some strategics, and some of them, as eager as they are to get involved and look at stuff, they don't want to be a part of a broad process. You know, and I mentioned this, you know, when we were talking the other day, a few of us, and it sounds like Melvyn has heard similar things. Like when I hear that, to me, that's code for, oh, so you want to be the only buyer at the table so that you can call the deal, you can call the shots. And I say that tongue in cheek. And this, you know, corporate development person on the other side actually said, not really. It's more just like things are so complicated right now, and we have enough to wrap our hands around that we can't get caught up in the process where there's 15 or 20 bids coming in. We'd rather just pass.
Yeah, I have a question for Michael and Melvyn. Are you guys finding that the strategics in this environment are more willing to do a deal and to make offers than the financial buyers are, given that, you know, they're looking for synergies, they're looking more long-term? I know there's crossover with the characteristics, but what are you guys seeing, and what is anyone else seeing?
I think if you look at strategics, a lot of them, depending on how shaken up they are from the pandemic, if they're in, and we've talked about sectors that have been less affected already, but if they're in one of those sectors, like I'm seeing press releases come across the inbox every day about, you know, Apple or a large tech company or healthcare company doing a deal, and it's a tuck-in acquisition. It makes a lot of sense. Great. But a lot of the more like small or mid-cap publicly traded companies or the other privately held companies, in terms of we have probably like 6 or 8 deals that are like in the marketing phase versus being in due diligence or in pre-marketing. A lot of strategics have actually been passing on deals unless they're incredibly core to their growth strategy. So I think a return to the core, and in the public markets too, you guys are probably hearing about like carve-outs, like Bed Bath & Beyond's carving out a bunch of businesses, especially in retail. There's a need to really raise cash. But for sponsor-backed strategics, I think there's probably more activity for them versus the normal strategics because, yeah, Jeff, to your point, there's economies of scales, there's cross-selling and channel synergies, there's so many different things you can do. And the EBITDA multiple or EBITDA base might be $5 million for you as a standalone seller to say a platform for a portfolio company or a platform for a private equity group, but it might be $8 or $10 million. So I think those groups are still very active. I saw a stat the other day. I think 70% of private equity deals since the pandemic have been add-ons. And part of that too, and if you think about strategics, right? Some strategics already have enough cash or they can use equity to do a deal, right? They don't necessarily need to raise as much debt. But a lot of sponsors, especially for platforms, lenders aren't going to be as comfortable with a new platform. They're not going to give the same amount of leverage as if it's a sponsor that's already, like we talked about, roll-ups that private equity firms are doing. If it's the 3rd or 4th or 5th add-on, it's going to be a lot easier to get there. But there's definitely a lot of choppiness right now, and it seems like the sponsor-backed strategics are the best groups in terms of showing a new deal, and then probably the pure play private equity groups, and then the regular strategics.
And the private equity groups, depending, some of them are licking their wounds more so than others. You know, and that goes back to the haves and the have-nots. The ones that are really, even if they're somewhat affected by some of their portfolio companies, but they have others that are doing well, they're more confident and more inclined to look at situations, whereas others that are, you know, I think of like the Massage Envies of the world and European Wax and any of these franchisors that are, you know, that are owned by private equity groups. I mean, we've dealt with a few franchisees that are trying to sell multiple locations of this, and it's just, you know, so I think it depends on how severe their wounds are within their current holdings. That's dictating how aggressive they are on the buy side.
Yeah. And let's not forget too, I think everyone is, I mean, the Fed came out yesterday and the Senate came out, and obviously there's going to be more stimulus on the way. But if something happens and there's policy changes, and we haven't really talked about the election or fiscal or monetary policy, there is a chance that the spigot of capital gets turned off, and the middle market and even a lot of these private equity businesses are going to be affected. So it's probably more of an aside, or we could have a whole other panel on it, but I think there's going to be a lot more distress and restructuring activity later on in the year.
Yeah.
Yeah, I think that's a great segue to my final question here, Melvyn. So thank you. And thank you so much, Melvyn, Michael, and Jeff, for your time here today. It's been very insightful. But I guess kind of to wrap up, closing thoughts, to Melvin's point, you know, how does the deal-making process change in the face of uncertainty, whether it be an election year with the coronavirus, us being late cycle? If you wouldn't mind each just kind of touch on that briefly.
So I'll start on that. I think my approach, and I started my firm 7 years ago after, you know, leaving the Wall Street world. My approach has always been one of open to flexibility is the key. Like an owner, like owners that, unless they're in a situation where they know their company is that strong and they can dictate the terms, owners need to be flexible. And now more than ever, if I sit down with an owner or have a call with an owner, really, I'm not doing too many sit downs, although I do them. I welcome them outside, but I want to make sure that they understand. Some of them still don't, they're not grasping the reality as it applies to valuation. And, you know, there are plenty that do and say, Mike, I get it. I know, let's test it. Because I'll tell them, I don't have the exact answer for you. You know, like nobody has the exact answer right now. We're all trying to figure out what the value is going to be. The only way to find out is to do this in a realistic manner and touch the right parties that could be the right fit. But you, Mr. Owner or Miss Owner, what's your mindset? I'm being super diligent on that because otherwise our business is predicated on closing deals, and there's plenty of times we don't close deals, but we don't want to waste time with an owner that's not mentally aware of the new valuations or terms and structure. I'm big on that. You could still get what you want. It's just going to have to be orchestrated differently. So that's my most important feature that I'm trying to understand from an owner, the first conversation right now.
Yeah, and to Michael's point, I think flexibility from owners is key, because, you know, a year ago, if they were expecting a valuation of X, and now that valuation is just, there's no market for it, they're going to have to, either they want to do a deal, or they're not willing to, and they're going to have to sit it out and wait hopefully for this all to pass and the economy things to turn around. But I think flexibility is key. I think the buyers, as I said before, do have a lot more leverage in this environment than they may have in the past. And so I think it's important for sellers to understand that. And of course, you know, you can't make a seller feel a certain way. They may have an emotional attachment to the business. They may be certain in their heads that their business is valued at a certain amount, and they're not going to settle for less than that. But I think it's important to bring that out at the very beginning, so you can have an honest discussion about it and be realistic at the situation.
Yeah, I think to both my fellow presenters' points, I think things are a lot better than they were before. I think markets are still choppy. Deal activity is ticking back up, but to sellers out there with the uncertainty, I think now is probably a better time if you absolutely need to raise capital, or maybe bring on a partner to do a minority recap, or get some growth equity, or get a refinancing of the debt on the balance sheet. It's probably a better time to do that than do an outright sale, because at Jeff's point, it is a buyer's market. There's certainly been some compression in multiples out there. But I think sitting tight in the form of uncertainty, unless you're being opportunistic and you have the capital and the wherewithal to do buy sides, is the right thing to do for sellers. But then again, if there's nothing wrong with just sticking with the core in this market and thinking about the type of changes that are happening, both from a technology standpoint and a lifestyle standpoint, and from the perspective of all of us, where we normally be sitting and having a meeting together, doing it on Zoom, thinking about how that affects the business model of our clients, and then helping them maybe pivot strategically. M&A is a cyclical market anyway, and I think it's important for business owners, even if they do want to sell, to make sure that they're going the right way strategically.
Well, thanks, guys. That was very insightful. Really appreciate all your input here today, and hope there were some good takeaways from the attendees. So with about 5 minutes left, I did just kind of want to see, in terms of the breakout rooms, who was looking to participate and stick around. If you're not able to make it, we appreciate your attendance, but I would just ask over the next 30 to 60 seconds, if you don't plan on doing that, if you could end the call and leave it, just so I can organize whoever's going to remain and would like to continue networking. So what I've posted it to the chat, I guess, that everybody can see on your little Zoom window, just some suggested discussion topics. Maybe we're going to do groups of 3, so a 30 to 60 second introduction of each person in the group, and then about 15 minutes touching on some different questions. How are you adapting your work processes to the current conditions? Some trends that you're seeing as your clients and the economy opens up, and maybe some stories about, best, worst, most inspiring situations you've experienced this month. So appreciate everybody's time. Hope it's a good breakout session for those of you who can stick around, and we're going to skip our meeting for August, and our next meeting will be in September. So we will send some information on when that will be, and hope you all can make it. So thanks for those who have stuck around here. I'm gonna just make these little breakout rooms, and then we'll all be able to kind of go into them and have some discussions separate than this call. So Jeff, Melvin, Michael, thank you so much, and hope everybody has a great rest of their week.
Great. Thanks, Matt.
Thanks everyone on the panel. It was great.
Thank you for listening to us ramble for an hour.
Okay. All right, now you should have all been asked to join the separate breakout rooms. So thanks, everybody. Have a great day.